Hello and assalamu alaikum everyone. So today we're going to talk about medium term external sources that are your leasing and hire purchase, as well as talk about another some other source of finance like microfinance. So in today's lecture we will talk about leasing, hire purchase and microfinance. So without further ado, let's begin. Leasing is basically obtaining the use of assets such as equipment, machines, or vehicles from a leasing or financing company. When we say we are using assets, that is like assets are acquired over the medium term by paying a rental charge over a fixed period, but not having to purchase the asset at the end of the period. So basically, it just involves renting of assets for a particular time period instead of purchasing the assets. That's basically what the hired idea is. Just the term used is a little different. And sometimes you might be asked what a lease is. So for that, I've written this definition over here that a lease is a contract outlining the terms under which one party agrees to rent property owned by another party. So let's say our business agrees to rent property owned by this leasing company. Okay, so it guarantees the lessee, also known as the tenant, that is the business, use of an asset, and guarantees the lessor, the property owner, or you can say or you can also say it as the, sorry, just moving a screen just a bit. Yeah. Okay. So it also, yeah, and guarantees the lessor, the property owner, or you can also say the leasing company, regular payments for a specified period in exchange. So we get the use of asset for that particular time period, and they get specified regular payments in exchange. And this is the contract basically that outlines these terms. So that's what lease basically is. It's just the same thing as renting, but in this particular thing, the rent is usually about assets like machines or vehicles, and you don't actually get the ownership of it because it's a rent like only. So it's just a rent for use. Okay. So leasing avoids the need to raise what may be significant amounts of capital to purchase assets, avoids high cash outflow, that is, and instead allows for small cash outflows over a fixed period, thereby having a positive impact on net cash flow. It is, you can say, an alternative to major capital investment. So instead of buying that asset in itself, you can just lease it and use it for a specific period as long as you need it by paying short rental. So you don't have to raise enough capital for, you know, you don't have to raise enough significant amounts of capital to purchase the asset. Instead, there will be small cash outflows taking place, small regular payments that you have to pay in order to use that asset. So that's good in the sense that it is basically very helpful in managing your cash flows. So when we talk about cash flows in the chapter of cash flow forecasting, we're gonna use leasing as a method of reducing our cash outflows. As you can see that instead of having one time payment for your assets, purchasing assets, you just use the assets for as long as you need with small cash outflows, not too large cash outflows. So that's the benefit of leasing basically. And leasing companies may maintain and update equipment, that is avoids maintenance and enhancing costs. So that's a plus that you get for leasing assets instead of just buying your assets. And business can also sell their assets to a leasing company and lease them back to use assets while having a positive cash flow from high cash inflow and small cash outflows. So basically the idea behind this point is that we have talked about selling our assets as a source of finance, right? And over there we just discussed that selling your assets and then leasing them back is also an alternative to just selling your idle assets, because you might need some assets later on. So instead of just selling them, you sell those assets to this particular leasing company and lease them back. That is, you rent those assets for however long time you need it. So basically that's the best benefit that you get, that since you are the one who sold that asset, you get a little discount as well. So the same thing, that instead of having so you will have high cash inflow by selling that asset and small cash outflows by leasing it. So that's the whole idea behind this. And yeah, this particular thing you can say is part of your internal sources of finance, but leasing in general is an external source of finance unless you sell it and lease it back. Sell your assets and lease it back. So hopefully this clears up this point of leasing. And the disadvantage of leasing is that you don't have to, like, you can only use the asset, you don't end up purchasing the asset. So if you want to use it later as well, then you'll have to pay rents again. You can't just, it will be a continuous cash outflow. So perhaps if you use it for a longer period of time, the one amount that you had to pay for once might have been cheaper alternative instead of just paying continuous rentals for a long period of time. So in that sense, leasing could be not too good of an option. Instead, in that case, you could just buy that asset. But since it's not too good for your maintaining your liquidity position, leasing is a good option for just if you want to just use your asset for a particular period of time. You don't have to like use it for as much longer period, and it has some other advantages like maintenance and updating costs are just covered up by the leasing company. So that's a plus that you get. But if you really want to purchase the asset, then that's where hire purchase comes in. Hire purchase is basically a credit for purchase transaction where a business eventually owns an asset by paying installments. Over there we are paying rentals but only using it. Over here we eventually own the asset by paying installments. It is similar to leasing as the business has to pay installments for a specific period of time to keep using the asset. At the end of time period, the business gets ownership of the asset. The key point to note over here is that the ownership is transferred to the business only at the end of time period, that is if they have paid all the installments. Okay, just do keep that in mind because this will be one of the disadvantages as well as we move on the discussion. So basically the advantages of hire purchase is that it can benefit the business with poor credit by spreading the cost of expensive items that they would otherwise not be able to afford over an extended period of time. So since you can just not buy that product asset in just one payment, so it spreads that one expensive cost into small costs so that you can just have good cash outflows and eventually own that asset as well instead of just purchasing that asset with one time payment. However, do keep in mind that it is not the same thing as extension of credit, like you buy something and then your credit is extended, you can just pay it later. No, that's not the same thing because in this case the business technically doesn't own the asset until all of the payments are made. So as we said that at the end of the time period the business gets ownership of the asset. Before that they're only using the asset. Okay, this usually proves to be more expensive in the long run than making a full payment on asset purchase due to high interest costs and installments. So that's a disadvantage that of course the businesses want something in return for having the companies that give you these assets through hire purchase. They generally want something in return, like they won't give it to you free by just having you like pay installments. They want something in return, so there's generally an interest cost and it may be high. So generally this option is more expensive than just making one time payment in the long run. But so it will eventually, you can say that it will cut into your profit margins, but it is good for managing your cash, that is. So it just comes down to another showdown between cash and profit, that which one do you have to favor more. If you want to favor your cash more, you're having some liquidity problems, you need to use your assets, you need to buy assets as well, but you don't have enough cash in hand right now, then you can go for purchasing. You will get your cash in hand later by perhaps you have sold your goods on credit sales, so eventually your customers will pay to you, so you will get that cash later on. But since you don't have it now, you just go with hire purchase. So it's another showdown between, as we said, that cash versus profit, and we're going to talk about cash versus profit later on as well, so you can understand this concept more clearly, why we choose hire purchase instead of one time payment. But I hope you get the idea that one time payment is sometimes not a good option, but where it is a good option, you should just make a one time payment instead of going with hire purchase, because it is more expensive in the long run. And another disadvantage is that the business is unable to own asset if it is not able to pay installments. So let's say you had to pay 10 installments, you paid 9 installments, but you were unable to pay the last installment, you were just illiquid, you just don't have enough time, and the one who was giving you this asset for hire purchase, they just take it back. So like you all those 9 installments will be counted as rents instead of just installments. So like you won't get the ownership of the asset. The asset, like you suffer a big loss because of the amount that the businesses have paid towards purchasing up to that point. So up to that point, whatever money you had paid in installments, all that is gone because you just couldn't pay all the installments. So all the previous installments money is just like used up as rent. So it will be similar thing as leasing, but of course those installments were probably higher than your normal rents in leasing. So that's a little risky over here. So if a business runs out of cash at a later stage, so it could be dangerous. So in this particular case, it might be better for going for full payment on asset if possible, but hire purchase in itself has its own pros and cons. It all comes down to the business in itself. What should the business, what is the current business situation, and what is better for that particular business. Finally, the last topic of discussion in today's lecture, that is microfinance. Now, microfinance is not you can say a short term, long term, or medium source of finance. These are some other sources of finance which are not classified into them, but you can say that it is often said that microfinance is a long term source of finance as well, because like it's similar to loans, but it's not like it has its own resource. It could be used for some other. It is just beyond a normal traditional loan. It's just more than that. So let's discuss what microfinance is. It is basically the provision of financial services for poor and low income customers who do not have access to banking services such as loans and overdrafts offered by traditional commercial banks. Now, customers over here do not mean your traditional customers. It only means your bank, your businesses only. But when the businesses go to get loans, they are actually customers. So in that sense, over here it's customers. But do keep in mind when we say customers over here, we generally mean entrepreneurs or banks. Sorry, not banks, businesses. So entrepreneurs use microfinance to start their own business, operate and expand the business, or to provide additional working capital for the business. So it provides finance which otherwise would not be available at high risk entrepreneurs with no credit score. So in that particular case, since microfinance is a very good thing, it helps you get access to finance when the banks do not offer you because of the high risk or your lack of traditional history. So when we are discussing about those problems with raising finance over there, microfinance could be helpful. It also encourages people to be financially independent and provides them with financial resiliency to be able to cover any large unforeseen expenses. So if there's any unforeseen expenses, that could also be paid with microfinance. And such finance is likely to provide at a lower rate interest rates than traditional bank loans, making it easier to pay back, because general aim for microfinancing companies is to increase the number of small businesses, to empower people, poor people, and empower women in particular, so that new businesses can be created. They encourages people to be financially dependent and all. It's basically you can say social enterprise generally offer microfinance, so that's why they have lower rates. But as you see that interest rates can be quite high, as well as the administration cost of providing many very small loans is considerable. Like you have to provide small loans, but a lot of small loans to many people. So the administration cost of that is quite high, and hence a business might charge higher interest rates and try to exploit people. Such people are also called loan sharks, but generally microfinance companies are generally social enterprises, so they try to avoid that. We are less on time, so we just have to wrap up this up quickly. It includes not only small loans but also provides a number of services such as saving and checking accounts, fund transfer, microinsurance, and microcredit, and even educational programs that teaches the principles of investing, focus on skills such as bookkeeping, cash flow management, and even accounting. So they don't just offer you some loans, as I said, that it goes beyond loans. It gives you so much services as well. Small capital sums in the form of loans to poor aspiring entrepreneurs have encouraged small businesses to be set up where previously there was no such funds. So I said that small businesses are most set up now. It improving access to such services allows those on low income to fund activities which will create income, build assets, and protect against risk. So all these services are being provided to growth of local economies takes place, that is, income rises and families are able to give education to the children. Overall stimulates economic activity and development, particularly through entrepreneurial activity, thus multiplier effect. So that's all for today. Thanks for watching. Allah Hafiz below on time. Sorry.